Hello, everybody, and welcome to the Money Max account presentation presented by United Financial Freedom, where we are buying America back one family at a time. The Money Max account makes it possible for you to pay off all of your debt in as little as 1/2 to 1/3 the time, with no change to your current budget, no debt consolidation, no refinancing, and no need for a second job. With the Money Max account program, there is no magic. It is just math. The owners of the company, Schuyler Whitman and John Washenko, started in the mortgage industry back in 1993 and were listed as one of the fastest growing companies in Utah for a 3-year running period. They became aware of the debt epidemic in America, especially through their mortgage clients returning every 3 to 4 years to refinance. They'd refinance to get out of debt and then buy cars and go on vacations and just run the debt back up, and they would have to refinance, creating deeper and deeper debt. And they were returning about every 3 to 4 years deeper in debt than they were when they did that first refinance. They kept spending, and they kept coming back to refinance. And both John and Schuyler had been through the experience and the pain of foreclosure in their childhood and didn't want to see their customers have to go through that. So they started seeking solutions to this debt crisis. In 2002, they focused on finding a cure for their clients' debt situation. They looked for a program that would rapidly pay clients' mortgages off, and they found in Australia that Australians were paying a lot less in interest than Americans were, and they came across a program that was being offered in England known as the One Account, but it had some drawbacks. You had to have a mortgage. The mortgage was a first position line of credit. You had to have good credit. You had to refinance and pay all the closing costs. These mortgages, the One Account, were on a variable interest rate, and they lacked technology to help the client navigate that. Schuyler and John worked with mathematicians and IT people, and in 2004 launched their first version of the Money Max account program. It was an award-winning debt elimination program. We'll see that in a little bit. In 2005 to 2006, they did a beta test with 400 homeowners, and to their astonishment, they found that 1 year later, those 400 homeowners, the majority of them were about 20% ahead of the schedule we had originally given them. In 2006, they launched United First Financial, with thousands paying off their home in as little as 1/3 to 1/2 the time. Thousands more were starting their journey to financial freedom with the program, but you needed to have a home equity line of credit to make the program work. In 2008, Ernst & Young awarded us Entrepreneur of the Year for financial services in the Utah region. And I don't know how many of you know who Ernst & Young is, but they perform very intensive due diligence on financials, longevity, retention, product viability, impact on the customers. And these same awards were given to companies like Apple, Starbucks, eBay, and Microsoft, and we have been featured in several publications for debt elimination. In 2008, we had the global financial meltdown, which was a great challenge to many businesses. Banks stopped issuing lines of credit. But even through that period, we as a company continued to service our clients that had purchased the Money Max account program. We had over 70,000 clients that had signed up to utilize the program. We went back and retooled, and we've invested now $19 million on development and research, and we eliminated the reliance on a home equity line of credit as the vehicle to drive the program. We relaunched the company as United Financial Freedom, and we can now help people that have bad credit and no mortgage. Traditional banking wisdom says if you want to pay debt off early, you have 3 basic options: consolidate for a lower monthly payment, refinance to a lower interest rate, or a biweekly payment program. With the Money Max account program, there is no refinancing, no standard of living change. This is not a biweekly payment. This is not a debt roll down, and this is not concept and theory. We have a 15-year proven history with this program. Disruptive technology is an innovation that significantly alters the way that consumers, industries, or businesses operate. A disruptive technology sweeps away the systems or habits it replaces because it has attributes that are recognizably superior. Now, if you look at the screen there, I'm sure everybody on this call has done business with at least one of those companies, and I am here to tell you that the Money Max account program and United Financial Freedom are disruptive technologies for 2020. I want to take a look at a mortgage amortization. I want to talk to you about a closed-end loan. This is what most mortgage products are closed-end loans. We're going to say that we have a $200,000 mortgage at 6% interest, and over a 360-month period, or 30 years, that would be a payment of $1,199.10. We can see that we make our first payment and the principal amount is $199.10. That means in month one, we are paying 83% interest on that first payment. Now, when we move into month two, we can see that our principal contribution increases by $1. Is it any wonder it takes us 30 years to pay this loan off? I want you to concentrate now on equity and paid. In year one, we've paid in $14,389, but our equity position is only $2,456. In year five, we paid in $71,946, and our equity position is only $13,891. And on year five, we have now paid $58,055 worth of interest. If we move into year 10, we've paid in $143,892, and our equity position is $32,628. And in year 21, we finally hit the halfway point. We have paid in $302,173, and we finally have a balance of $99,877. Now, I don't know about you, but paying that much money in and paying all of that money in interest, I would feel this loan was done. Remember, on this loan, if we make every payment on time, we pay back $431,677. That, to me, is nothing more than legalized extortion. If you had a $300,000 mortgage at 4%, it's all relative. Your first year, you'd be paying 69.26% interest. In year five, you'd be paying 63.94% interest. In year 10, you'd be paying 55.97% interest. And in year 15, you'd still be paying 46.24% interest. There has got to be a better way, and we have created that better way. Now, I'm going to say something here, and you can read at the top, and it's going to go in the face of everything that you've ever learned about finance. What if I told you you could use 10% money to pay off 6% money? Well, we all know on a primary mortgage, being a closed-end loan, that if we are up to date with our current payment, we can apply any additional amount of principal that we want to apply. So let's take a look at what it would look like to use an open-end line of credit against a primary mortgage and what that interest cancellation would look like. So let's say we make our first payment in the amount of $1,199.10 in September, and that leaves us with a balance of $199,800. Now, I want to draw your attention to the lines that say interest and principal. And what we're going to do is write our first payment in the amount of $1,199.10, and then we are going to go to our line of credit, could be our credit card, and we are going to borrow what represents the principal for October, November, December, January, and February. Now, what I want you to get out of this screenshot is that principal and interest in this amortization schedule are connected. So we've written out our first check for $1,199.10 to be applied as the mortgage payment, and then we're going to write another check totaling October, November, December, January, and February's principal totaling $1,010. And we're going to direct that money be applied to principal by the lender. Well, watch what happens. Remember I said principal and interest are connected. By doing that, we eliminate October, November, December, January, and February's interest. That means we saved $4,985 off the back end of the loan, and we invested $1,000 to do that. So the question is, in any other arena, would you invest $1,000 in yourself to get $4,985 back? And I think we can all agree that would be an equitable exchange. So How do you pay debt off early? Our program causes every dollar you make to either earn interest or cancel interest. The 4 requirements you have with our program is you need to have debt, you need to have a checking account, a savings account, and you need the Money Max account program. Optionally, in the Money Max account program, you can use advanced lines of credit such as home equity lines, personal lines, business lines, and credit cards, but as well, we are talking about the utilization of an open-end loan that has a lot more flexibility to it, and the bank adjusts principal balance and interest charges every time a payment is received. So we see with this type of loan, we have a lot more flexibility than we have with just trying to conquer our primary mortgage, and we're going to show you how this works in conjunction with eliminating your debt. The Money Max software utilizes 8 basic banking principles, and we're just going to go through 4 of them here: interest accumulation, interest float, interest cancellation, and strategic debt payoff. So let's look at a possible scenario. We're going to say that John and Rebecca Jones make $5,000 a month in net income. They have $4,800 in total living expenses, which leaves them $200 in discretionary income. Their debt load for this example is a $200,000 mortgage at 6% interest with a payment of $1,199.10 over a 360-month or 30-year loan, and they also have a line of credit or a credit card at 12%. If we look at interest accumulation, month 1, we have our $200,000 mortgage. We're going to get our paycheck and put it into checking, and that's going to show us with $5,000 of income. The Money Max account program is going to tell us to transfer that $5,000 over to our savings account, which is now earning 3%. We are going to utilize the idea of interest float and use our credit card or our line of credit for our bills throughout the month, for everything from our house payment, utilities, gas, groceries, everything. And so we're going to pick up the float on that credit card by doing this. So in month 1, we decrease the interest on our primary mortgage by $199, and we increase our savings account by $12 at 3%. This is the idea of interest accumulation. We move into month 2 and we get our $5,000 of income. The program is going to tell us to take that money, and we're going to look at interest float now, and we're going to float our expenses on our credit card or our line of credit for 30 days at 0% interest. When we get the bill in the mail, we're going to write 1 check for $4,800, and we're going to pay the credit card bill off to 0, leaving $200 in reserve in our checking account. The program is then going to initiate a funds transfer. This is to kill the interest on our mortgage and tell us to transfer $3,789 from our savings account back into our checking account. And then by doing this, the program is going to initiate a funds transfer and tell us to make a payment of $3,989 from our checking account to our primary mortgage. By doing this, we eliminate 18 payments and we save $18,000 of future interest. That's $18,000 taken off the back end of the loan. This is the idea of interest cancellation. We're going to float our expenses throughout the month again, just like we did in the previous months, and then we're going to repeat, rinse, and wash again. So interest cancellation, before they did the transfer of $3,898, their balance was $199,801. After, the balance is $195,612. It reduced the balance by $3,989. Payments still remaining before would be $358. After we did the transfer, we are now on payment 342 of the amortization schedule, which means we eliminated 16 mortgage payments. John and Rebecca should have had to pay back $231,677, but by doing the funds transfer, now they will pay back $212,931. That means they wiped out with just that one funds transfer $18,746. You know, if you're trying to do something like this on your own, you have another dilemma, and that is, how do you decide which debt to pay First, how much money do you send? When do you send the money? You know, there are all different philosophies out there that you hit the highest interest rate first, you hit the lower payment interest, the lower payment first, you hit the one with the highest interest and the lower payment. All of these different ideas on how to pay off debt, none of these are based in mathematics, whereas with the Money Max account program, everything you do is based in the mathematics. So with a start balance conventionally of $200,000 and a 30-year mortgage paying back $231,677, with the Money Max account program with a starting balance of $212,402, they will pay all of their debt off in 14.9 years, and they will only pay back $109,201. Quite a difference from that $231,677 that John and Rebecca were scheduled to pay back. This means that John and Rebecca saved $123,185 plus 15.1 years of mortgage payments they can now stash away for their retirement. So why couldn't you do something like this on your own? Well, the Money Max program computes the optimal time to leverage money and float and cancel interest to pay off all of your debt in record time. I know the process may look simple or sound simple, but the formula has millions of lines of code, many different algorithms hard at work all the time to mathematically calculate automatically. Banks have relied on this math and timing to make money work for them. Now it's your turn to bank like a bank and make money work just as hard for you. Just like a GPS, the MMA constantly recalculates, taking every single aspect of your financial situation into account. Do you have multiple streams of income? Is your income commission-based? How much do you owe and for how long? Are interest rates fixed, adjustable, simple, amortized, compound? The program has the ability to anticipate what's coming down the road, like vacations, holiday spending, tax returns, unexpected expenses such as medical bills. When life is just happening, your program will automatically recalculate and guide you to pay off all of your debt, make complicated decisions for you. It helps you to stay focused. It tracks your success, helps you and assists you in freeing up the money essential to build wealth, and it knows the exact day and year you will be debt-free. The Money Max account program does not move money and does not pay your bills. There are no account numbers and no Social Security numbers in your program. No one has access to your money. The Money Max account program acts as an account register, and it wants to know how much money is coming in and how much money is going out, tracks and maintains your budget, and it only takes about 20 minutes per month to update your account and integrate the information necessary so the program can do its job. In summary, the Money Max program helps eliminate all of your debt in a fraction of the time. It helps you make educated financial decisions instead of just guessing. In many cases, for most of our customers, it actually improves their credit scores. You own the program for life, so you can use it on multiple homes, multiple investment properties, things of that nature, multiple debts. There are no mandatory monthly fees or contracts or surprises, and that means that lifetime updates, live customer support, and coaching for the life of the program. The question you have to ask yourself is, how many families need our message and product? Do you want to be the emissary for life change in your family and friends' lives? How many families do you personally want to help, or would you share this message? Results always speak for themselves, and to date we have helped our clients pay down $2,038 million of principal. That does not take into account how much money we have saved them in interest, or if they have taken that money and started investing that money, or use that additional money from that loss of mortgage payments and other debt payments to buy second homes, to buy investment properties, to build for their retirement. Will it work for you is the next question. Well, we can't say for sure because it depends on a few variables. The only way to find out is schedule a free financial analysis with the person that referred you to listen to this presentation. Then you'll know that achieving your financial goals begins with debt elimination. Ask the UFF agent that invited you to this program to run your free savings report. You have nothing to lose but time off your debt and hundreds of thousands of dollars of interest that you could put back in your pocket. Let the numbers do the talking. Get with the individual today that invited you to this presentation and let them run your free analysis. We want to thank you for joining us for the Money Max account presentation.